happy Friday. We'll give everyone a few minutes to trickle on in, but in the words of what we're just chatting about, I do like the idea of saying, we're going live on a Friday afternoon, which is a good energy to bring into the weekend, don't y'all think?
Awesome.
I love it. Well, first off, just wanted to say welcome everyone. Excited to be here on this webinar today. For those who don't know, I'm Brenna Nath. I'm the director of HW Plus and events at HW Media. And our topic today is overcoming obstacles to e-closing adoption, hosted by Stavvy, which is super exciting. A few quick housekeeping items before I pass things over to the experts. And I wanted to just start off with saying, we'll be having a Q&A session towards the end of the webinar. Feel free to drop your questions throughout the webinar. These three have so much knowledge to give. So we'll save those to the end. As you think of them, drop them into the chat function or the Q&A function, and we'll get to them at the end. And we'll also, the second note for housekeeping is sending a copy of this webinar to everyone when it's over. So whether you're scrambling to take notes or you just want to listen and then take notes later when you listen, we'll be sending that in an email to everyone, as well as having it on the website for you to peruse and download. So without further ado, I'd like to introduce our moderator today. Our moderator is Jeremy Potter. He's the Chief Evangelist at Stavvy. You guys are in great hands with these three. So with that, Jeremy, I'll pass things over to you.
Thank you, Brenna. Thanks for having us. I'm excited to talk about this topic today. What we wanted to do was bring together a panel who could have a candid conversation about some of the strategies, processes, levers, and obstacles to e-closing adoption, primarily for lenders. And what we thought would be a good way to frame up those things for lenders, for you and your business who are still thinking about how to approach this, how to adopt it, what your strategy is going to be, what your timeline was going to be, to bring together experts on the title side and the capital markets side. And so I'm joined today by Nick Hacker, Title Team. The Title Team is a multi-state title company in the upper Midwest. Nick's going to talk through things around how his agency, how his company has been thinking about adopting technology, what successes they've had, what they're seeing and hearing from lenders, and what the client experience, the customer experience has been, who's adopting this fastest, what are the best use cases, where are your closings seeing the most benefit, most return on investment. Obviously, you start talking about return on investment, and we want to talk about the capital markets and some of the executive decisions that also have to happen around e-closing. And so I'm joined by Jim Deitch. Jim is the CEO and co-founder of Teraverde. Before Jim co-founded Teraverde, he was the CEO of bank. He's been on the boards of banks and non-depositories. He's been an advisor, a board member at the MBA. And so we are lucky to have his experience and talking through what lenders and those others in the industry are telling you, Jim, about their experience going digital and what that actually means to the bottom line. Thank you both.
Thank you.
One of the things I like to talk about is we really wanted to be practical in some of the areas that we talked about, but this is not going to be a how-to, the 3 to 4 steps you take or the 5 steps to create an e-closing process. This is much more going to be about the types of decisions you'll have to make, the types of strategies that different lenders are already taking. And if you're watching this and you haven't yet made a decision on your e-close strategy or your e-close timeline, I think you'll get a good understanding of where you are relative to the market and what you might be capable of doing to make the case inside your organization about some of the client experiences and return on investment, cost savings that you're seeing. So whether you're in the capital markets, whether you're in the closing area, operations, or you're a technology provider, hopefully we'll give a really good sense of the landscape. I think one of the things that I like to start with is it's hard to talk about the landscape without talking about what we're even mean when we say e-closing. I found in the last year or so at Stavvy that e-closing means a variety of different things to different people. And depending on where you are in the ecosystem, depending on what your responsibilities are, depending on how you were introduced to digital closing tools or digital closing platforms originally, it all influences how you think about it. So the way we think about it at Stavvy are the different types of e-closing. Because of course, take a hybrid closing, for example, the first case I'll talk about. A hybrid closing is an e-closing because it involves some portion of electronic document execution. It is just not entirely electronic document execution. And so I start with hybrid because it really frames up nicely the two different categories or quadrants that you're working with. The first one is, are all of the document signed electronically or not? So what's the condition of the document? The second one is, where are the people who are executing those documents? Are they together? Are they on a machine? Are they together on a machine? And that ends up nicely framing up things beyond hybrid closings, such as remote online notarization, remote ink notarization, and in-person electronic notarization. So a lot of times when I think about client experience, a topic we're going to talk at length with Nick about, I like to think of those two questions. Where is everybody? And what type of machine are they on? Now, I won't really call the pen a machine per se, but you can think about it and you kind of understand what I'm saying. And those help to define what we're talking about. Remote online notarization tends to get the most attention because that's been the state legislative activity since COVID. But remote ink notarization was probably the largest adopted solution during the emergency orders of COVID. And some states just decided to remove that altogether once they deemed the emergency over. And some just converted their emergency order to a more permanent order. So the result is we have about 43 states where remote online notarization and then all of the subsequent e-closings below that are allowed or are going to be effective within the next year or so. And then we have some holdouts. We've got attorney states, California. And then one thing we'll talk about a little bit later as we get into some of the questions and the dialogue here is how additional factors that I haven't mentioned yet, like an e-note, for instance, weigh into your decision, either from a capital markets perspective or from a return on investment perspective. And one thing that's always important for us to note at Stavvy is that actually e-notes are already active in all 50 states. There's no new state legislation for those. It's really about the notarization, the state notarization laws before we get to a critical mass of, we're at a critical mass, I should say, before we get to an entire map of RON eligible states. And so when I think about making these decisions, adopting new technology, having to be flexible to a variety of technologies and a variety of business partners, at least in my role at Stavvy, I think of title companies, because title companies have to manage the expectations of their clients, their referral partners, and not all referral partners choose the same technology. And so as a result, it's typically title companies that have the experience logging in to multiple platforms as banks, credit unions, and mortgage companies decide what technology, what communication tools, what doc collaboration tools, what all-in-one platform they want to be on. So Nick, you have that experience watching lending attempt to address e-closings, as well as then choosing to adopt e-closings in your business. And I think we'll just start there. Can you talk as someone who has moved forward with an e-closing strategy and is conducting RON closings in your state? Just tell us a little bit about that experience and some of the reasons you adopted these types of technology.
Sure, Jeremy. And I think I would just step back into that question. First off, really great to be with you today. We're really excited to talk about what some in our industry are doing, like ourselves. And we're the title team. We're Upper Midwest, offices across primarily North Dakota and Minnesota. And the way that we think about RON, RIN, all of these different things, hybrid. And let's just start off with the hybrid signing process that's been underway. That's nothing new. We've been watching the loan origination process, utilizing these hybrid approaches from loan origination all the way through post-closing, and including ourselves in the sense that, in 2016, we had tablets in all of the offices and then, different tools to assist in some of the document signing, so that we took a loan package that used to be this thick to like this thick, right? And so today, almost all lenders are utilizing some form of a hybrid signing when it comes to the loan closing. Then, of course, there's title documents in there because there's also a real estate closing that happens too. And so we have to think of the two as almost separate and distinct. And but it's been really great because now we only have like maybe 5, 6, 8, 3 documents, depending on the lender, that need to be executed, many times wet ink. And so we're really excited about where the lending industry is going. But we don't really think efficiency is created in a RIN type of process, or even in this hybrid. It's a little more efficient. There's not as many documents to sign at closing. but the consumer still had to review those documents and sign them electronically. Sure, it was great because they were in their pajamas. Sure, we're trying to meet them where they want to be met, but ultimately we really won't meet them or that piece of the marketplace where they want to be met until RON is really adopted. And so our industry really undertook, along with, so the ALTA, which is our National Trade Association, along with MBA, developed a model act. And this is where our industry spent a lot of time laying the groundwork as it relates to the notarization of the document. And so back in 2016, 17, 18, pre-pandemic, we're all sitting around saying, someday somebody's going to want to sign these things electronically. Let's go make sure our statutes are in good order. And a lot of states, such as the states that we operate in, went and adopted those laws back then. So that's where our heavy lift was related to the notarization of the document. And so that's kind of our backdrop, and we were doing it really out of necessity. Nobody was really asking for it. And then bang, the pandemic hits, right? And our whole world has changed in March, April of 2020. And now the necessity really grows, our need to actually provide that service. And if you think about just the backstory of, think about your parents or your grandparents who had never been on a Zoom call a day in their life. And today they're actually many are very comfortable with Zoom or whatever what have you. But I think I would take a moment and just talk about how much easier video communication like we're doing today has improved, right? So we have these consumers wanting us to meet them somewhere, but it's clunky. It didn't really work very well. We utilized several other vendors to try to do this. And so ultimately, as an industry, we're trying to meet them where they wanted to be met, but the solutions weren't very good, to be honest. They were terrible. And so I think the providers, the vendors like Stavvy and others have really upped their game in a way that we can now utilize this technology in a way that's really comfortable for people to do their signing remotely. So I think that's kind of like where we've come. And so as a company, what we've done is really looked at that and said, how can we take advantage of this and really push? And so for the last just about a year, we've really been out trying to really promote why would we want to do a RON signing, not only because of what it means to the consumer, but actually the efficiency and what it means to us.
Sure. I mean, what I'm hearing as well is that, when you introduce paper, that's where you introduce cost, manual processes, and human error. So even in using some technology with some paper, you've still not really addressed those core obstacles or those core things that can introduce even one costly error into the mix. And so paper has, its own restrictions. But then there's a second piece of hybrid and RIN, slightly unrelated to paper, which is great. You get a little bit of an advance notice on some of your documents, but you're still getting in the car, you're still driving somewhere, and more in the hybrid than the RIN, obviously, but you're still back and forth physically with either shipping, driving, showing up. Even if you have a smaller package to sign, you still had to do a lot of the things, especially in a hybrid environment, that interrupt your day. And then the third thing I heard was like, hey, look, and I say this a lot, FaceTime didn't make me a better spouse, a better son, a better friend, right? It just gave me another way to connect with the people in my life and have additional opportunity to be a better friend, spouse, or what have you with the people in my life. And so your value here distinct from how you end up connecting with consumers.
Yeah, Jeremy, for sure. I mean, we're the last people your client is going to see, right? And so that experience really matters. And that's why when I kind of mentioned that the technology platform has to be consumer friendly, but it also has to be friendly to our ecosystem or our environment. Because as you mentioned, once we print one document, all of those manual processes are back in place. All of that scanning, all of that packaging something back, all of that sometimes mailing things out is reintroduced back into our entire ecosystem. And so ultimately there was very little efficiency. Where we're able to get with a RON transaction is what I think you're alluding to is Instead of us now sending documents, so literally here's where we gain our most efficiency, because it's just actually really silly when you think about what we go through to, let's say we're signing a conveyance document, we need something notarized. We literally contact the client, let the client know, here's attached as a document. I need you to go print that document. And by the way, don't forget it's 8.5 by 11, or it's an 8.5 by 14 legal size, right? We got all these different paper sizes. Okay, and hopefully it prints correctly for the consumer. Okay, then what we're going to ask you to do is go find a notary, go to some bank or teller and see if they'll notarize this document. Oh, by the way, in the email, we also had to attach a FedEx label. Okay, so when you're done signing at the bank, go down and find a FedEx place and put this in a package, send it back to us. Meanwhile, the originating lender is sitting there saying, can we really close on Thursday because you're still waiting on the deed, Nick? Exactly. We don't know. Maybe it was delayed. Maybe a consumer had a hard time finding the FedEx drop off. Okay. And so then they send it back to us and we get this paper package. Then we take this paper and generally we're scanning that in, right? And then we conduct our loan signing with the originators. And so with Ron, we're able to more firmly keep those closing commitments when we have a remote seller, which is primarily what we're using Ron for today. B, we take all of that out of the picture and we just say to Bob and Sue or whoever, the sellers, hey, you got 10 minutes to jump on a computer. And boom, we're done. And we're e-recording the document. Oh, by the way, we're not rescanning. We get all of the electronic documents back. They get copies of their electronic documents, which they would probably prefer over paper. And then we're ready to move on with the loan closing and maintain those timelines.
Jeremy, I just have to jump in here because I'm doing a HELOC with a lender, and I just got a notice yesterday that I need to drive to a branch to sign the HELOC documents, and the nearest branch is 70 miles.
Oh my goodness!
And my reaction was, "There's got to be a better way."
Yeah.
And I'm still waiting to hear what that better way is. So maybe we ought to give the link of what we're talking about here today, because it's happening right today. If you think we're so used to people just going, well, you have to. No, I don't. I'm not going to drive 70 miles to do a HELOC. Are you kidding me?
That's right. No, I couldn't agree more that the consumer expectation is a huge piece of it. We worked with a lot of the measurements of trying to think about what time is lost before you even get to paper and gas, by the way, Jim, just what time is lost in the consumer's life or in the professional's life. So whether it's Nick has to dispatch, like you said, a local notary that he knows in the area where the remote closing is, or this mail away closing is, or somebody from a law firm and an attorney state has to drive, or the consumer has to drive. Now you're asking Jim to come to the branch. So before you even get into paper and gas, just thinking about people's time and what are the more valuable things we could be doing and working on while we delegate some of these other tasks to technology and also get the savings. So I couldn't agree more. One of the things that
I laugh at that, please, Jim, because like literally 2% of people even want to go sign their HELOCs in person. It's not really an experience anybody cares about unless you're there to pick up a check at the same time.
Yeah. So if there's any lenders on here that want to do a HELOC and you can e-sign it, jingle me.
Maybe switching it up. We're going to generate business for the lenders who are listening. We're going to generate some business for Nick while we're on here and hopefully move the ball on this adoption. There was one last thing that, Nick, you mentioned that I really wanted to dig into before we bring Jim on as well, which is in a more substantive way on the capital markets side, which is you mentioned the use cases. Here's what we're seeing from mail away closings. Here's what we're seeing from clients who are a perfect fit for Ron, and we've adopted it for those reasons. Can you talk a little bit about your sustained success adopting this technology earlier than a lot of others? And then who are those that are the best fit in your practice for an e-closing?
Yeah, so Jeremy, it's a great point. We really shifted from necessity to, okay, let's really pursue with a real purpose of why. And then what does that mean to our efficiency? And so, and I don't want to go talk about that, but how we sustained that is obviously we had the pandemic. Well, that taught us a lot of things. And so where we're at today is we never do a seller mail away. I mean, we really don't want to do that because we're not in control of the documents anymore. If you think about from an efficiency standpoint and making sure that from a compliance standpoint that the consumer or seller or borrower has executed where we want them to execute, I can manage that in a virtual environment much more proactively than they go down and find a notary and sign and they miss a signature, right? And so from a quality control standpoint, it's just way more proactive to do it electronically. It's almost fail-proof, and so that's how we've sustained it, is to really say we're gonna utilize this tool in any instance where the borrower or seller can't be in our presence. And it actually creates a more secure environment because we've multi-factor authenticated somebody. It's stronger than actually doing a regular wet ink notary because we actually know something about the person, so we run, kind of a background check, if you will, and we validated who they are. So from our standpoint, we've actually strengthened our ability to avoid fraud and forgery and those sort of things. But that's how we've sustained it, is we've really just said we're not interested in really mailing things out, and people aren't really interested in receiving those things in the mail. And so that's how we've kind of juiced our kind of pipeline. And so that's kind of where we're headed. And then we just talk about it a lot. And real estate agents are like, by the way, I'm in North Dakota, right? And so in about a month or two, a bunch of our clients and sellers, they're not going to be in North Dakota anymore. They're going to be in like Arizona. Right. And so it's just awesome to offer that option for those folks. And then
sorry, Jim. Sorry, Nick.
Go ahead, Jim.
Go ahead. Well, I was going to say, Jim mentioned 70 miles to a branch. When you mentioned North Dakota, South Dakota, Montana, Minnesota, I mean, you have Minneapolis, obviously, that you mentioned earlier, but I'm thinking 70 miles is half the distance for some of your clients. And so that's the other thing that popped into my head while you were talking. That's nothing for your clients.
Yeah, definitely. We have a lot of people that travel quite a distance to come to a closing. But it doesn't matter if you're in the Minneapolis Metro and you have to go from the South Metro to the North Metro. It's still an hour and a half.
Yes.
Or if you're in rural America. And the interesting thing is rural America too can take such advantage of this. When you think about like a rancher or a farmer, and you think about the equipment on board their John Deere tractor, that they type in some GPS and they type in how fast they want the auger to turn, and then they take their hands off the wheel and off the controls and they get to kick back and relax for a while. They love the technology because they're used to it. And so we see market adoption, especially with late stage millennials on older, to be really good. And we see kind of that mid stage and younger millennial and younger than that, they actually want some in-person experience. And so we're here to really meet them where they want to be met, in person or electronic. We see both having a part of the future.
That's great to hear. I mean, those are great. So saving time across town, whether it's a Friday afternoon, rush hour, work day, not having to get across across a big city, or to your point, I'm gonna take that story, and if you can drive your tractor off of GPS coordinates, you can delegate part of your work to technology. You can start doing other stuff. You can start working on more complex innovation, more complex work as a farmer, or as a closer, or as a title team. And so I really appreciate that. I'm definitely gonna be using that story. Jim, the other thing that Nick brought up that on one hand brought me some flashbacks of when I first got into this industry, and the FedEx truck came at 6 p.m. And if you had something that had to be on that FedEx truck that day, you were running out the door to try to get from our desk inside the mortgage company out to the curb to get that on the truck, because otherwise you'd be either chasing the truck down the street or you'd be out of luck for that day. And so on one hand, I got a little bit of reminiscing, the nostalgia of the urgency on a Friday, trying to get that last FedEx truck. But then my ears perked up on another point, which was efficiency visibility and reducing errors. And those all go right into your world. When you're talking to executives, you're talking to CEOs, you're talking to capital markets folks, it's all about certainty and it's all about risk mitigation. So maybe we'll pivot to you now, Jim, and talk a little bit about how you see the savings and efficiency, the benefits of eClosing when you put kind of that lens on this new opportunity.
Jeremy, thank you. And there was a question from the audience about on HELOCs, there may be a state limitation on whether or not it can legally be settled.
Sure.
And here's the point I'd like to make, and it ties into your question on efficiency. I'm a consumer. There may be a requirement that an electronic execution of documents or HELOC isn't feasible. I don't care. I'm not driving 70 miles. If lenders need to think about the consumer experience, regardless of regulatory syrup that may be slowing things down, there has to be a better way to deliver consumer experience than to say you need to drive 70 miles. Whether it's in this industry, someone can figure that out. I'm waiting to see how they figure it out, but I did just simply say, I can't do that.
Yeah.
And it's just not going to work for me. I can't. So appreciate that question from the audience.
Yeah, thank you. And Jim, just real quick, we will take questions. So keep those coming in, keep the comments and questions coming in, because we want to have some time here at the end of the hour. Brenna will come back on and we're happy to do Q&A and make sure we're digging in on the important stuff. So please keep those coming in. Go ahead, Jim.
So here's some things for us to consider for both the lender and title communities. The MBA put data out for the second quarter of 2022. The cost to originate a loan for 360 lenders that are part of the Mortgage Bankers Profitability Reporting was $11,000. It was $10,977. 68% of that was labor. And of that 68%, half of that 68% was operational labor, not cost for compensation for loan originators, managers of loan originators. It was everything aside from sales compensation. So said another way, $3,700 was spent as people pushed paper around the mortgage banking environment. And oh, by the way, that's done 12 million times a year, not including HELOC. So if I were doing a pitch on Shark Tank, and I said, this is a great business, 68% of my costs are labor, they're not leverageable. And oh, by the way, I'm going to do this 12 million times a year. Mr. Wonderful would look at me and say, stop the madness. So ladies and gentlemen, let's stop the madness, right? The efficiency, that $3,700 of costs on just back office, not all title, but literally processing, underwriting, closing, shipping, stipulation clearing. That is a real high number, and it starts at the back end of the consumer experience of getting the ability to do an eClosing. Because if you do that, you accomplish a couple things. First, I've done expert work on loan fraud. Matching signatures is not a good way to have your insurance carrier or your lender, your investor say, I'm going to keep this loan even though it's in default. Fraud has real costs, and it is highly unlikely if you do an electronic closing, you're going to have trouble with signatures not matching. So that's number one. Second is the speed that you transfer the risk of that mortgage for a lender to the investor is paramount. When you close a loan, the reps and warranties on the transfer of what's happening and the reps and warranties you're making to your GSE or correspondent counterparty are not made the day of closing. They're made the day of funding. So the faster you get that loan funded, the faster you transfer that risk to the purchasing party. And if you think about what those risks are, it includes the person was employed the day you closed the loan, but they lost their job. And before you sold it, that person's unemployed. That loan is now unsaleable. And there's a whole series of things that go on that. So saleability and speed to credit risk transfer is a huge benefit of eClosing. The second piece is the faster you fund a loan, the faster you get that hedge cost from ticking away day to day to day to day. So if you can take 1 or 2 days off from the time it's closed until the time your investor funded, you're talking about 2, 3, 4, 5 basis points. Doesn't seem like much, but in the first quarter of 2022, lenders made 8 basis points. That's 3 days carry on hedge costs. Ladies and gentlemen, the faster you do this, the better off we are. And then lastly, the risk of repurchase because of defects in the signature structure, the documents that may be missing, the fact that someone had to revise a document, all these different things can cause repurchases. And the other thing I remember as lenders for ladies and gentlemen is in the first quarter of 2022, $1 billion worth of loans were pushed back by the GSEs for repurchase. There's a publicly traded company that announced its second quarter earnings and took a $38 million repurchase hit. And the CFO's comment was, well, the good news, these were just due to document defects. That's not good news in my book. That's bad news because it's avoidable pain that we just wasted $38 million of shareholder capital on. So, Jeremy, those are a couple of reasons that this is real money and real efficiency. It's labor, it's risk mitigation, and it's repurchase defense.
I appreciate that perspective because it doesn't get much stronger for a capital markets person than the bottom line, than what they can deliver, whether it's quarterly, annually, however you're looking at it. So that is a really big win. The other thing that struck me in your comments is we're often talking in these types of moments about new product development, new product innovation, expansion to try to capture either more leads, more referral sources, more consumers, of course, more volume. And so if your folks at any point in the value chain or the ecosystem are working on fixing errors, document issues, manual processes, what they're not working on are those harder things that our industry could tackle. A digital HELOC might be a great example, given what you mentioned earlier, but we're not anywhere near where we need to be on housing supply, things like renovation, things like condos, things that are typically seen as more complex products or more complex processes for mortgage companies. And one of the things we could do is solve for a lot of what we are working on to the tune of $38 million in one case, and adjust both the money and the folks in that process onto those things that would really capture revenue opportunities for not just the next cycle, for this cycle right now.
I think that's an excellent point. I mean, speed of innovation, speed of the product. Just you know, going back to your comment, I was thinking about STIPs, and you know, I've done a lot of loans in my career, and the most difficult things to do are to get documents corrected after you fund the loan, because at that point the consumer doesn't really care. They got their money, and they're not going to go out of their way to do anything. And you can waive the, well, you signed a waiver here or a pledge that if there are document defects, you'll fix them. Yes, I did, but that doesn't mean I'm going to make it easy. And that, I think, is a real key point. And all this interrelates, Jeremy. You know, some folks think about this as cost save. Some of the folks think about this as consumer experience. Some folks think of this as, this is a quick way to get innovation. This is a faster way to get close, a way to avoid investor STIPs. It's really the beginning of the transformation of the mortgage banking industry, because the more you can get in terms of electronic, not documents, but get to data, the faster you can get all of this digitized. So you're not scanning, stacking, doing all these other things that are no value added, that take a very large amount of labor. It's super important. Super important.
I appreciate the certainty, the return on investment, and especially the speed. Is there anything that comes to mind here before we switch to open it up for some questions and for some further dialogue? Is there anything, Jim, that strikes you as the next area of opportunity for adoption? Or let me put that question another way, maybe the remaining obstacle that any lenders have mentioned? I mean, we've put out a strong case as we wanted to here, but what would maybe be the strongest thing or the strongest obstacle that you've heard about that lenders are struggling with?
You know, it comes to adoption. And, you know, I'm reminded of a speech that John Kennedy gave at Rice University in 1961, announcing the program in which the United States would put a man on the moon and bring him back before 1970. And the closing piece of that was, we don't do this because it's easy. We do it because it's hard. This is hard to do because it's really affecting the hundreds of thousands of people that work in our industry that are used to doing it the way they're used to doing it. Adoption is really important. I had a nice several conversations with Jonathan Core, former CEO of Ellie Mae, and his comment to me was, with his particular LOS, less than 10% of the native automation capability was in use by the typical lender. And their North Star was to automate everything automatable, which the technology could do, but it was really the focus and the leadership to say, we're going to do this. The greatest blessing we got out of COVID, if there are any blessings, is the acceleration of the number of states that adopted the ability to close first mortgages remotely because of the need. That was a great blessing. Not too much, nothing else really good came out of COVID. That's probably the only thing good that came out of COVID. But what I see there is the pump's been primed. We've made some structural regulatory progress that's the hardest thing to make. Now it's a question of leadership and will. So if we can put a man on the moon in 7 years and bring him back safely, why can't we get loans closing electronically in the next 7 months? It's just not that hard. It is a matter of will. And yes, there's still some regulatory hurdles in certain jurisdictions. There's still some product issues. There's still a lot of things there, but the majority of the transactions are likely candidates for some e-closing. So Jeremy, that's my thoughts.
I think you're right. Critical mass on the state legal framework, because to Nick's point earlier, it's such a localized, customary process and traditional transaction that the state's tipping over to be the vast majority and well on our way to getting the last few holdouts to a 50-state solution. I think depositories in particular had a wait and see approach to get to the number of states to make the investment, meaningful. I think we're there, but I think that, to your point, is a really good observation that you just made. And then I think the second thing that we think a lot about at Stavvy, things I think a lot about, is orchestrating all the moving parts. I think for a really long time, consumers and other industries may have looked at real estate, mortgage, title as one thing or one industry, but internally, I think we, for a very long time, looked at those as separate industries. You're in the real estate industry, you're in the mortgage industry, you're in the title industry. And increasingly, both competition, consumer expectations, and technology are allowing us to create experiences that are all in one, or that are seamless to the consumer, or to the closing shop, or the operational folks, or the loan originators. And so I think that's also been a tipping point that maybe we haven't experienced as an industry. We're all coming in with a lot more sophistication around how technology talks to each other.
There, that's an interesting point, Jeremy. Certainly the ICE with the purchase of MERS, Simplifile and LMA has really moved it's converged data as it is accumulated end of loan. And my guess is there'll be more opportunities there technologically where you have investors who have the ability to make the investment in the infrastructure to digitize that will facilitate this. And that e-registry, I think, is a good example of how we've really taken the friction out of elements. So
sure is. I invited comments and questions, and our friend Harry from MERS submitted one. So I'm glad we touched on that. That works out well. Nick, I'm going to invite Brenna on, and we'll talk through some Q&A here in the last 10 minutes or so. But the first question that came in, Brenna, that I was going to ask Nick about, and then I can talk about Stavvy's experience as well, is what about if a county recorder, register, despite having a state law and having e-recording be approved, doesn't accept it, whether that's a practical reason, a technology reason, a cultural reason. What are you seeing relative to having to paper out an electronic notarization? You have any issues with that?
In general, Jeremy, we have most of the state laws that have passed, the vast majority have a paper out clause in the statute that allows us to paper it out, put a certification that we signed that remote online notary, and submit that for paper recording by the recording jurisdiction, and they will take it. Of course, there's sometimes personalities on the other side. We work with a lot of different counties, but usually we push hard enough, and they will record the papered out version. The RU-LONA statute, which stands for the Revised Uniform Law and Notarial Acts, that it does contain a paper out clause, as well as the Alta MBA Model Act. So the vast majority of states allow you to paper that transaction out.
Great, I appreciate that. We had New Hampshire as one of the more recent states to go live with their effective dates. We had that, there was one kind of holdout county for a bit that we used that provision and solved for that. So I appreciate that. Brenna, what other questions do you have? What other questions came in?
Yeah, you three, I find it so fascinating in what a webinar that we can bring up tractors and how they've modernized to going to the moon and how that has happened. And so I find it exciting that eClosing can be in the realm of those exciting changes as well. So great examples that I think you three covered, along with so much more insight. Excited to dive into questions. As Jeremy said, loved the comment from Harry, especially knowing that Harry is an eClosing expert as well. Feel free to comment, question, anything that you want to submit for these three. The chats are open, but I'll jump right into this first one, which is, I'd say a question that is maybe my favorite, because as someone who went through a drive-through closing experience during the pandemic and got my picture, we still took our classic title picture and posted it on social like everyone else, even though we were in our cars. It was a little out of the norm. I think this question really tees up, we have made the closing experience very much a ceremony. Like there's a certain ceremony that goes along. How does Ron remove that closing experience for millennials? I am a millennial myself. I took that as an experience in the cold Colorado weather, and first-time home buyers. And I think you all can speak to this, but maybe Nick, if you wanted to jump in first.
Yeah, I think it really comes back to, we know that there are certain clients that want that closing table experience. They want the real estate agent little gift or whatever. They want to get the keys slid across the table along with the garage door opener, etc. We know that there's a large segment of those parties that still exist. As far as it comes to remote online notarized closings, we really focus on making sure it's still a human interaction. Like you and I today are having a conversation. And so we spend time with our closers, because we use all of our own real estate closers, just utilizing the technology. I think that's something important for lenders to think about, is that experience with that human contact with somebody that knows something about my transaction. So we aren't one to outsource that relationship, because we think the relationships matter. And so we want that human contact, whether it's in person or you and I having a conversation just digitally. And so the platform we use, which is obviously Stavvy, is it allows for multiple participants. And what I mean by that is it's not just the title agent and the signers. We allow the lender to join in that virtual session, like we are today with multiple participants, or the parents, or the real estate agent, or an attorney. And so we make it a collaborative environment. And so we're finding it's really pretty successful at maintaining the relationship.
And Brenna, I have two thoughts. One is it also has some potential to open up new experiences and new ceremonies around frequently asked questions, education, and accessing some of the expertise in the room in new and interesting ways that I think can be interesting. But I also think it goes back to what Jim said earlier, which is the consumer market research shows us that consumers want what they want when they want it. And so it isn't necessarily about being entirely digital all the time. That's too broad a generalization. It is that I need to have the solution on demand when I need it throughout the entire process. And so one of the things about choosing technology and thinking about technology in this industry is you do end up in a situation where you have to be able to serve that expectation for consumers, real estate agents, financial advisors, mortgage loan originators, title agents, because it's, hey, I need to have all the tools in my toolkit because I want what I want when I want it is the expectation of the person coming in to the funnel, to the transaction. And the companies that have all of those at their disposal are going to be the winners.
Yeah.
And I just like to add stories sometimes because we witness a lot of these. And the last thing a lender enjoys doing is sitting at a closing table, watching one of the spouses execute on the other spouse's behalf with a power of attorney. If you think about it, these people walk out of there with a cramped wrist and they're like, hey, we can click, or we no longer need a POA. As an example, we have a lot of deployed military spouses. And it's like, hey, why don't we all have everybody jump together and we sign or click away, and we don't have to have one of those military spouses sitting there, the long form as POA for blah, blah, blah. And it's painful when you think about what we put certain consumers through. I mean, it's just horrendous that we would ask them to do that, right? When we have technology at our fingertips to make that experience so much better.
Well, and experience-wise, I'd much rather settle the property and just get to the home and put the key in the door and say, hey, this is mine, whether it was my first home or my second home or whatever. The last thing I want to do is sit and sign my name a bunch of times and certify that of the people of all the papers I haven't read, I'm going to be in full compliance with these as I execute them. I mean, it just, the mortgage is a tool. The closing is a tool to get in your home. It is not a product in and of itself. And the more friction that comes out, the better off we are.
Yeah. I love that Jeremy mentioned in his answer too, that it's also an opportunity to transform what that experience looks like. Don't get me wrong, love a good social post to promote stuff, but I think there's a lot of education awareness that can even go into the wrong process. And I remember in the world of stories, I think I threw off my title agent because I'm so in the weeds in title that I got an email, and I'm so hyper aware of, title fraud. I was like, I'm going to wait till I see her to do anything with this document. So I got there and I was like, I just didn't know if it was safe. And it threw her off because I was like, no, I mean, you don't understand. I'm just in this world so much. And so she's like, oh, okay. And then it walked me through it very much so. But I think that education awareness is such a huge element and an important aspect to mention. So I love that, Jeremy, that was an extra factor that you added in. This next one is a question around, I think, a theme that I know, Jim, you touched on. I think Jeremy, Nick, you could also kind of add in, and it comes to this world of adoption. And I know, Jim, I think you just touched base on this probably like 5-10 minutes ago, but knowing that the past year, you mentioned the one good thing that came out of the pandemic and COVID was this adoption movement of like, we don't have a choice. We have to do this. And a whole bunch of states pass emergency regulation. All of a sudden, housing's all over the news for being able to push this through. What are lenders still trying to do, knowing that there has been so much progress, but there is obviously not 100% adoption? What are lenders trying to do to improve adoption, to help take it to the finish line, whatever the finish line looks like in this world? Is it working? Is there more that can be done? Is there any barriers to this? So I'd love a little bit more color, especially as we wrap up Q4 and go into 2023 in this new world. What does more adoption look like?
That's a great question. So I think of it in a couple of layers. The first is there still are some jurisdictions that we need some enabling legislation or some improvements to be able to do it. So that is an industry-wide push that comes from the market participants working with the legislative side. So that is one area. But the biggest, I think, area is I talk to lenders and CEOs in particular. There's a frustration that there's a view that this has to be all or none, meaning, well, not all states can do this, or not all jurisdictions can do this, not all products will accept it, not all investors will accept it. So let's just hold off. Adoption doesn't happen 0 to 100. Adoption happens to get the majority of the transactions going forward, and then you can manage the exceptions down over time. And it really is a matter of will and resource. I mean, think of how we would have been able to handle 2020 and 2021, $9 trillion of unpaid principal balance if we had not had some of the adjustments made regulatorily to allow the eClose in one form or another. It really goes back, and I have some C-level people that get pretty upset with me because this is a matter of leadership and will. Put the resources out and just put a stake in the sand and say, we're going to do it. 68% of our costs are spent on people. There are not a lot of people that like change. So this is a leadership issue in which you have to incent change, drive change, and finally, for the laggards, push change, or else we'll never get there. And I think the technology to do this is there. Some of the things, such as what Stavvy has created to be that kind of overall enabling platform, is really, really important, but it really is a matter of will.
So that's what we use when we think about starting with the end in mind, that capital markets mindset that Jim mentioned earlier, which is, I got to have an exit strategy for this loan. Most capital markets folks, that's how they're thinking. Who's buying this loan? And so when you think that way about digital, when you start with the end in mind, I want this commitment, I want digital, I want the return and all the benefits we've talked about throughout the day. The way we think about it and the way we've addressed it is twofold. One, are you using an opt-in or an opt-out strategy for digital? When we had a conversation with a lender who used an opt-in strategy and applied that to the branch manager or the MLO, and they had about a 30% pickup of digital closings by asking the MLO up front, opt-in to digital. When they moved that to the consumer, in their consumer experience, same question, opt-in to digital, they had a 70% attachment rate or success rate. So we know consumers want it, but that's still opting in. If you create an opt-out strategy, which is this is a digital closing and you have to affirmatively opt out, then, and which you can do, right? Still a consumer right, they're welcome to do it, but it changes the experience and it defaults you to digital rather than defaulting you to paper. And that's a huge change that we think lenders should think about. The second thing we built was just the question around jurisdictions that Jim mentioned, the eligibility engine, so that when you type a street address in as a branch manager, as a consumer, as a closer, whenever you choose to do it, you type that street address in and you get a red or a green on what the capable closings are, what the eligible closings are for that street address. And that's a big game changer to put everyone at ease on the front end of the transaction. I know I can dedicate this closing, I can identify this closing as an e-closing right from the start.
You both and all three of y'all have been dropping some amazing statistics. Those are the things I probably want to love that you guys have those numbers off the top of your head, and especially the power of, to your point, Jeremy, opt in versus now all of a sudden if it's an opt out, that could completely change the narrative in the industry. In our final few minutes here, I would love to just go around real quick, maybe starting with you, Nick, then Jim, then Jeremy, with your final thoughts. I think closing, eClosing, Ron, this whole world, there's so many moving parts to it. And I know we covered a lot here today. Some of it we've touched on adoption. Maybe you want to talk more about where things are critical in this conversation. So if you each wanted to give a final closing thought going around that you want to leave our attendees with, I think that'd be a great, just kind of final tangible piece of advice or insight for them. Nick, if you wanted to kick us off.
Sure. Market dynamics are changing. We're doing a lot of, self-reflection, if you will, and really trying to uncover those opportunities for additional efficiency. And this is right at the forefront of how we can create a more efficient process for our business. We're flirting with that. About 5% of sellers are signing. We think the industry, could quickly get to 30%. We're extremely excited about this fourth quarter, Q1 and Q2 of next year. We think, and we know the lenders, and some have made certain announcements, but that are moving. It's a big ship to turn, right? And we're a much more smaller, nimble industry. As I mentioned, we did a lot of our work up front prior, in 16, 17. So we're really excited. I'm opportunistic about 1 year from today about where we'll actually be. And it does come down to leadership, as Jim was saying. And that was one thing we did, is we just put a stake in the sand and said, we're going to do it. We're going to do it really well. And we had pushback because we have humans that work here, right? And some people have been in this industry a long time. So, we came up with our internal strategy of how we were going to put a carrot out there for the rest of the crew to kind of follow along. So we're excited about where everything is going. And my last comment to Jim, we have several lenders that we are doing their HELOC signings for them via Ron, just as an FYI.
Yeah.
That is happening in the industry.
Jim, would you want to add in your closing thoughts?
Yeah, I'll give you 30 seconds. It is a question of leadership. It's a question of will. So if you're in the leadership team of the lending side in particular, it's not, let's get to 100%. Say, this quarter it's going to be X, next quarter it's going to be Y, next quarter it's going to be Z. Make part of that your incentive to the people that are charged with adopting it, and then walk up the curve. Whatever you do, if you just wait for someone to decide, you've got to do that. And there's all kinds of strategies. Jeremy pointed the opt-in, opt-out. Just put a pin in it, walk it up until we get to 80%, and you will be amazed at how fast you'll get there.
Great points.
Thank you. Yeah, I appreciate that. I'm going to build on something that was mentioned earlier, which is, while the strategy and the decision-making needs to be holistic, there are ways to address this that allow the best use cases, the best channels, the best referral sources in your business to be the leaders. So I think one of the keys that I've experienced and that Jim and Nick are talking about is, despite making the choice, we're going there, we're going to the moon. The way you get started can actually be the highest, best jurisdiction, product, referral source, or channel. And that's really how you're going to see tangible results. And then the ROI won't be the one we're talking about industry-wide. It'll be yours, and you can sell that internally.
Yeah. I like that closing comment. We're going to the moon, so you can join us if you want to get aboard, you can. Well, that was amazing answers and insights from all three of y'all. We have come to the end of our webinar on this Friday. And just before we jump off, a few housekeeping things and just thank yous. First, I want to say, Jeremy, Nick, Jim, thank you so much for your time today and your insights. Really appreciate you three joining us.
Awesome. Thank you.
Thank you.
Yeah.
Thank you.
And then I also want to say thank you to our panelists and our attendees. Our attendees appreciate you asking your questions, sharing your insights along with your comments. If anyone submitted a question, or if you have questions after the fact, after you kind of mull on this, they'll be contacting you directly, and feel free to reach out if you have any questions in the future. Like I said at the start, we will be sending out a copy of this webinar recording to all registrants within the next week. And we'll also have it available online at HousingWire.com underneath our webinars page. So you can check it out there as well if you miss out on that email. And which is closing thoughts. Thank you three. And I appreciate everyone joining us on this Friday, and hope to see you guys again soon. Thanks, everyone.